Before we dive in, please remember that I am not a licensed financial advisor, and this video is for educational and informational purposes only. The information provided is not intended as financial, legal, or tax advice. Every person's financial situation is unique, so please consult with a qualified professional for advice tailored to your specific circumstances before making any real estate or investment decisions. Let me tell you about two people. We'll call them David and Jessica. 10 years ago, they both decided to buy a property. They bought nearly identical 3-bedroom houses in the same middle-class neighborhood for the exact same price, $300,000. They both went to the bank, filled out the paperwork, and got a loan. Fast forward to today. David is comfortable. He has a nice home, he's paying his mortgage every month, and he's built up a little bit of equity. He's living the standard American dream. Jessica, on the other hand, is a multimillionaire. She owns a portfolio of 12 properties that generate over $10,000 a month in passive income. She quit her job 5 years ago and now travels the world. So what was the difference? They both started at the exact same place. The difference wasn't luck. It wasn't a secret inheritance. The difference came down to one single question the loan officer asked them on day one, and the wildly different answers they gave. That question was, will you be living in this property? That one question separates the world of homeowners from the world of real estate investors. And misunderstanding its power is the single biggest mistake that costs aspiring investors a fortune. You see, when you hear the word loan, you probably think it's just a pile of money the bank gives you to buy a house. But that's not true. In the eyes of the financial world, there is no such thing as just a loan. There are two completely different universes, the home loan universe and the investment loan universe. And they operate under a completely different set of rules, a different language, and a different physics of money. Thinking they're the same is like thinking a go-kart and a Formula One race car are the same because they both have 4 wheels and an engine. One is designed for a pleasant ride around the park. The other is a high-performance machine engineered for one thing: winning. Let's put these two loans in the ring and see who they really are. First, in this corner we have the home loan. You might know it by its other names: an owner-occupied loan, a primary residence mortgage. This is the celebrity of the loan world. It's the one you see advertised everywhere. It's the golden ticket. The government loves this loan. Banks love this loan. Why? Because it represents stability. It represents someone putting down roots, becoming part of a community, and having a deep, personal, emotional reason to never, ever miss a payment. This is their home, their sanctuary, where their kids sleep. The risk of them just walking away is incredibly low. Because of that low risk, the entire system is designed to give you, the home buyer, the VIP treatment. You get the lowest interest rates, the lowest down payment requirements, and the most flexible qualification guidelines. It's the financial system's way of saying, welcome to the club. We want you to succeed. Now, in the other corner we have the challenger, the investment loan. Its aliases include a non-owner occupied loan or a rental property loan. This loan isn't a celebrity. It's a grizzled business tycoon. It doesn't care about your feelings, your family, or your picket fence. This loan is a cold, hard, calculating business tool. When you apply for this loan, the bank isn't looking at you as a community member. They are looking at you as a business partner. They are entering into a venture with you, and their only question is, will this venture make money? They know you don't have that deep emotional attachment. If the rent doesn't come in and the numbers don't work, your incentive to walk away is much, much higher. It's just a line item on a spreadsheet. And because the risk for the bank is significantly higher, they treat you completely differently. The velvet rope is gone. The VIP lounge is closed. They demand higher interest rates, they require a much larger down payment, and they will scrutinize your finances and the property's potential income with a microscope. It's not personal, it's just business. The fundamental disconnect, the reason people like David stay stuck while people like Jessica build empires, is failing to grasp this shift in the lender's mindset. When you apply for a home loan, the bank is underwriting you. They look at your W-2, your credit score, your debt-to-income ratio. Their central question is, can David the person afford this monthly payment? But when you apply for an investment loan, they are underwriting the deal. They're still looking at you, of course, but the property itself becomes the star of the show. Their central question is, can this property generate enough income to pay for itself, cover all expenses, and still leave a profit? They are betting on the asset, not just the individual. This is a game-changing distinction. One is about your ability to earn a living. The other is about your ability to analyze a business and manage an asset. So let's stop talking in hypotheticals and get down to the brass tacks. What are the real, tangible differences you'll see on paper? We're going to break down the 5 key battlegrounds between these two loans, and the first one is the biggest barrier to entry for most people: the down payment. When you're buying your primary residence with a home loan, you hear all these magical numbers. You can get a conventional loan with as little as 3% down. You can get an FHA loan backed by the government for just 3.5% down. If you're a veteran, you can get a VA loan for the holy grail of real estate: 0% down. 0. You can literally get the keys to a house for less than the cost of the security deposit on a rental apartment. On a $400,000 house, a 3.5% down payment is just $14,000. That's an achievable goal for millions of Americans. The system is designed to get you in the door. The bank is willing to finance 96.5% of the purchase because they know you'll be living there, and government-backed insurance programs like PMI or private mortgage insurance protect the lender if you default. It's a low-risk proposition for them, so it's a low cash requirement for you. Now let's walk across the hall to the investment loan department. You find a great rental property also for $400,000. You walk in with the same financials, the same great credit score, and you tell the loan officer, "I'd like to put 3.5% down." They will politely laugh you out of the building. For an investment property, the game completely changes. The absolute minimum down payment you will typically find is 15%, and that's rare. The industry standard, the number you need to have burned into your brain, is 20% to 25% down. So on that same $400,000 property, you don't need $14,000. You need $80,000 to $100,000 in cash, plus closing costs. Why the gargantuan difference? It all comes back to risk. The bank needs you to have significant skin in the game. They want you to have so much of your own capital tied up in the deal that the thought of walking away is financially devastating to you. That $80,000 equity stake is their cushion. If the real estate market takes a 10% dip, they're not worried. The value of the house is still well above what they've loaned you. Your equity takes the hit first. It's a buffer that protects the bank. Without it, the deal is too risky for them to even consider. This single factor, the down payment, is what separates the casual dreamer from the serious investor. It forces you to be a disciplined saver and a strategic planner. You can't just stumble into buying a rental property. You have to be intentional. You have to be capitalized. And this is just the first difference. The next one, interest rates, is where the banks really start to make their money, and it affects your cash flow every single month for the next 30 years. So let's talk about interest rates. This is the engine room of the deal. It's the number that dictates your monthly payment, your total cost, and ultimately the profitability of your investment or the affordability of your home. And the difference between a home loan and an investment loan rate isn't a rounding error. It's a chasm. Why? It all boils down to one word: risk. From a lender's perspective, you, the homeowner, are a fantastic bet. You live in the property. Your kids go to the school down the street. Your memories are in those walls. You have a deep, emotional, and practical connection to that house. If you hit a rough patch financially, you will sell your car, eat ramen noodles for a month, and do whatever it takes to make that mortgage payment. The last thing you want is a foreclosure sign on your front lawn. You are what the banks call a low-risk borrower. Now let's look at you, the investor. You don't live in the property. You have a tenant in there, or maybe it's vacant. To you, this property is a line item on a spreadsheet. It's an asset designed to generate income. If the tenant stops paying rent, the economy tanks and the property value drops, your calculation changes. Your decision to keep paying the mortgage becomes purely a business decision, not an emotional one. You might look at the numbers and say, "It's better for me to cut my losses and walk away." This makes you, in the eyes of the bank, a significantly higher risk. And how do banks handle risk? They price it in. They charge you more for the privilege of borrowing their money. This extra charge is called a risk premium, and it's baked directly into your interest rate. Typically, you can expect the interest rate on an investment property to be anywhere from 0.5% to a full percentage point higher than it would be for an identical loan on a primary residence. You might be thinking, okay, 1%. What's the big deal? Let me assure you, it is a very, very big deal. Let's run the numbers, because this is where the theoretical becomes painfully real. Imagine you're getting a loan for $400,000 on a 30-year fixed mortgage. Scenario A. It's your primary home. The bank loves you. You're low risk. They offer you a competitive rate of 6.5%. Your monthly principal and interest payment would be about $2,528. Scenario B. It's an investment property. Same $400,000 loan. Same 30-year term. But now the bank sees you as a higher risk. They add a risk premium of just 0.75%, bringing your interest rate to 7.25%. Your new monthly payment? $2,728. That's a $200 difference. Every single month. That's $200 that could have been cash flow in your pocket. That's $2,400 a year. Over the course of 5 years, that's $12,000. That's a new roof. That's a kitchen renovation. That's a significant amount of money that is evaporating into thin air, going straight to the bank's bottom line simply because of the loan's label. But the monthly payment is just the tip of the iceberg. The real shock comes when you look at the total cost over the life of the loan. Back to our example. On that home loan at 6.5% over 30 years, you will pay the bank over $510,000 in interest. That's right, you paid more in interest than the loan was even for. That's how amortization works. But hold on. On the investment loan at 7.25%, the total interest you'll pay skyrockets to over $582,000. Let that sink in. That seemingly small 0.75% difference in the interest rate will cost you an extra $72,000. A brand new luxury SUV, a down payment on another property, college tuition for a child, $72,000 gone. Poof. That is the price of risk. That is the power of a percentage point over 3 decades. This fundamentally changes the game for an investor. That $200 higher monthly payment means the rent you need to charge just to break even is $200 higher. It makes finding a property that actually cash flows, that actually puts money in your pocket each month, exponentially more difficult. You're starting the race with weights strapped to your ankles, and it affects how you build equity. In the early years of any mortgage, the vast majority of your payment goes towards interest. With a higher interest rate, an even larger portion goes to the bank. So, on the investment loan, you're spinning your wheels for longer, paying pure profit to the lender while the homeowner next door with a lower rate is chipping away at their principal balance much more effectively, building real, tangible wealth faster than you are, even with the exact same loan amount. It's a completely different financial reality. The homeowner gets a subsidized rate because they provide stability to the housing market and to the bank's portfolio. The investor pays a premium because they are introducing a business-level risk. It's the cost of entry into the real estate investing game. You have to account for it in your every calculation. You have to find deals that are good enough to overcome this built-in disadvantage. So while the down payment requirement we talked about is the barrier to entry, the interest rate is the silent, relentless force that shapes your financial journey for the next 30 years. It dictates your cash flow, your total return, and the speed at which you build wealth. It's the single most important number in your loan documents after the loan amount itself. And this difference in risk doesn't just stop at the interest rate. It fundamentally changes how the bank even looks at you as a borrower. The entire process of getting approved, the paperwork you need, the hoops you have to jump through. It's a different world. The underwriting process for an investor is a far more invasive, skeptical, and demanding ordeal. And that's where we're going next. Because if you think the math was tough, wait until you see the scrutiny you'll be under. Let's get one thing straight. The reason for this scrutiny isn't because the banker, let's call him Mr. Smith, is a bad guy. He's not sitting in his office stroking a white cat, looking for ways to ruin your real estate dreams. He's looking at you through a completely different lens. A lens of pure, unadulterated risk. When you apply for a primary home loan, Mr. Smith sees a family. He sees a dream. He sees emotion. He knows statistically that you will move heaven and earth to avoid foreclosure on the roof over your children's heads. You will eat ramen noodles, sell your car, and work 3 jobs before you let the bank take your home. That emotional equity, that skin in the game, is a powerful unwritten insurance policy for the lender. Your desperation is their collateral. So, when underwriting your home loan, the process is standardized. It's a checklist. They look at your W-2s to confirm your job. They pull your credit score to see if you're reliable. They verify your down payment to make sure you have a stake in the deal. They run your debt-to-income ratio to ensure your paycheck can cover the mortgage plus your car payment and credit card bills. It's all about you, the individual, and your personal ability to pay the bill. The house is almost secondary. Its main job is to be worth enough to cover the loan if you default. The process is stressful, yes, but it's a well-worn path. It's a path designed for an employee with a stable job buying a place to live. Now let's switch chairs. You walk back into Mr. Smith's office, but this time you're not a homebuyer. You're an investor. You're not talking about a home. You're talking about an asset, a line item on a spreadsheet, a business. And in that instant, everything changes. Mr. Smith's entire posture shifts. The friendly banker is gone, replaced by a venture capitalist. He's no longer funding a dream. He's making a calculated bet on a business, and you are its CEO. And he's going to vet you like he's about to hand you the keys to his entire company. The emotional equity? It's gone. Vanished. In the lender's mind, if this investment property goes south, if the market turns, if you can't find a tenant, if a major repair bankrupts you, what are you going to do? You're going to cut it loose. It's a business decision. You'll do the math and realize it's better to let the bank take the property than to keep pouring your own money into a losing venture. You'll protect your primary home, your family, first. The investment property is disposable. The lender knows this. They know they are first on the chopping block. This fundamental shift in risk is the source of the underwriting gauntlet you're about to face. It's not just a checklist anymore. It's an interrogation. And it attacks you from 4 different angles. First, they scrutinize you as a business operator. They're not just looking at your W-2 income anymore. In fact, for some types of investment loans, they barely care about your day job. They care about your resume as a real estate investor. Have you ever owned and managed a rental property before? If so, they want to see the proof. They want to see Schedule E tax forms from previous years, showing you've successfully managed properties and declared rental income. They want to see leases, bank statements showing rent deposits, proof that you know what you're doing. If you're a first-time investor, you are a massive flashing red light. You're an unproven CEO. You have no track record. You're asking them to be the first investor in your brand new, unproven company. To overcome this, your personal finances, your credit score, your income, your assets, have to be absolutely stellar beyond reproach to compensate for your lack of experience. They need to believe you are so financially strong that you can survive your own rookie mistakes. Second, they scrutinize the property with a microscope. For your primary home, the appraisal was simple. The appraiser walked through, made sure it was in decent shape, and confirmed it was worth what you were paying. For an investment property, the appraisal is a different beast entirely. The appraiser is now a forensic accountant. They aren't just determining the property's value. They are determining its income potential. They will complete what's called a comparable rent schedule, or a Form 1007. They will analyze rental listings in the immediate area for similar properties. They will determine what they believe the fair market rent is. And here's the kicker. The lender will use the appraiser's number, not yours. You might have done your research and think you can get $2,000 a month in rent. But if the appraiser comes back and says the market rent is only $1,750, then $1,750 is the number the bank uses in all its calculations. That single opinion can completely torpedo your deal, turning a profitable investment into a money-losing one in the eyes of the bank. Third, they scrutinize the math on a whole new level. Forget the simple debt-to-income ratio. For investors, the holy grail is the debt service coverage ratio, or DSCR. This is a term you absolutely must know. The DSCR is a simple formula. It's the property's net operating income divided by its total debt service. In plain English, for every $1 you owe the bank each month for mortgage, taxes, and insurance, how many dollars of rental income is the property bringing in? A DSCR of 1.0 means you're breaking even. The rent exactly covers the mortgage payment. No lender on earth will approve that. It's a guaranteed default the second the faucet leaks. Lenders are looking for a DSCR of 1.2, 1.25, or even higher. This means they require the property's rental income to be at least 25% more than the monthly payment. They are forcing you to have a built-in profit margin, a cash flow buffer from day one. This single metric dictates whether the deal lives or dies. If the appraised rent is too low, or if interest rates push the mortgage payment too high, your DSCR falls and the lender walks away. Finally, and this is often the biggest shock for new investors, they scrutinize your cash reserves. For a primary home, you needed your down payment and maybe a couple of months of mortgage payments in the bank. For an investment property, they want a fortress of cash. They want to see 6, 9, sometimes even 12 months of full payments, principal, interest, taxes, and insurance sitting in a liquid account. And that's per property. Why? Because they know reality. They know tenants leave. They know roofs leak. They know air conditioners die in the middle of July. They need to know with absolute certainty that if your property sits vacant for half a year while you search for a new tenant and replace the furnace, You can still make the full mortgage payment every single month without breaking a sweat. You can't tell them, "Oh, I'll cover it with my paycheck." They don't care. They want to see a dedicated pile of cash, earmarked for this property's survival, that proves you can weather the storm. This reserve requirement can add another $20,000, $30,000, or $40,000 in cash you need just to get to the closing table, on top of your already larger down payment. This entire process, the scrutiny of your experience, the property's income, the DSCR math, and the massive reserve requirements, is a deliberate, calculated stress test. It's designed to be grueling. It's designed to weed out the unprepared, the uncommitted, and the undercapitalized. The lender is making a cold, hard business bet, and they're doing everything in their power to stack the odds in their favor. Surviving this underwriting gauntlet is a feat in itself. Proves you're a serious player. But it's only half the battle. Because once you've passed the interrogation and proven you're worthy, you then have to pay for the privilege of borrowing their money. And the price tag in the form of down payments, interest rates, and fees is a whole different level of pain. Let's start with the down payment. This is the first, most brutal filter that separates the casual dreamer from the serious player. For a home loan, the one you get for the house you're actually going to live in, the system is designed to help you. You've heard the old rule. You need 20% down. But for a primary residence, that's largely a myth. It's the ideal, sure, but it's not the reality for millions of Americans. You can get an FHA loan, backed by the government, for as little as 3.5% down. On a $400,000 house, that's $14,000. Still a lot of money, but it's within the realm of possibility for a dedicated saver. You have VA loans for veterans, which require 0% down. A USDA loan for rural areas? Also 0% down. Even a standard conventional loan, the kind not explicitly backed by the government, can be had for as little as 3% or 5% down for qualified first-time homebuyers. Why are lenders so accommodating? Because you are going to live there. Your kids will go to the school down the street. Your favorite coffee shop is on the corner. Your life is interwoven with that property. From a lender's perspective, this makes you a fantastic risk. You will do almost anything to avoid foreclosure. You'll eat ramen, cancel Netflix, and sell your car before you let the bank take the roof from over your family's head. You have an emotional and physical stake in the game, which is the best collateral a bank could ask for. Now let's flip the coin. You walk back into that same bank and say, "I want to buy that same $400,000 house, but this time I'm going to rent it out." It's an investment. The lender's friendly smile tightens. The posture changes. They're no longer dealing with a hopeful homeowner. They're dealing with a business owner. And business is risky. To them, an investment property isn't a home. It's an asset on a spreadsheet. It's a line item that's supposed to generate profit. And if it stops generating profit, if your tenants stop paying, if the market dips, if a major repair drains your cash reserves, your emotional attachment evaporates. It's just a bad business deal. You're far more likely to cut your losses and walk away, leaving the bank holding a vacant property. Because of that risk, the bank demands a much bigger commitment from you up front. The 3.5% down payment is off the table. The 5% is a fantasy. For an investment property, the industry standard, the absolute floor, is typically 20% down. More often, they'll require 25%, sometimes even 30%. Let's run the numbers on that same $400,000 house. For your primary home, you might have needed just $14,000. To buy it as an investment, you need $100,000. That's not a small difference. It's a chasm. It's the difference between being in the game and watching from the sidelines. The bank needs to see your money on the line. They need to know that if things go south, you stand to lose a massive chunk of your own capital, making you far less likely to just hand them back the keys. That $100,000 isn't just a down payment. It's a hostage. It's your guarantee to the bank that you'll fight for this property, because you have so much to lose. But the financial gauntlet doesn't end there. The down payment is just the entry fee. The real long-term pain comes from the interest rate. Again, it all comes back to risk. For your primary home, you are the lowest possible risk, so you get the best possible rates. These are the rates you see advertised on TV, the ones that get splashed across websites. They're called conforming rates, meaning they fit the standards set by government-sponsored entities like Fannie Mae and Freddie Mac, which provides stability and lower costs for the consumer. For an investment property, you are a higher risk. So, you pay a higher price for the money you borrow. The interest rate on an investment loan is almost always higher than on a home loan for the exact same person on the exact same day. How much higher? It can vary, but a good rule of thumb is anywhere from 0.5% to a full percentage point higher. Now, 0.5% might sound like nothing. Sounds like a rounding error. But this is the insidious genius of how banks make money. That tiny sounding difference compounds into a staggering amount of money over the life of a 30-year loan. Let's go back to our example. To make it a fair comparison, let's say you put 25% down on both properties, so you're borrowing the same amount of money, $300,000. Let's imagine the interest rate for your primary home is 6.5%. A very reasonable rate in today's market. Because it's an investment property, the bank tax on 0.75 of a point, making your rate 7.25%. On the home loan at 6.5%, your monthly principal and interest payment would be about $1,896. On the investment loan at 7.25%, your payment is $2,046. That's a difference of $150 every single month. That's your phone bill. That's a nice dinner out. Every month for 30 years, you're paying an extra $150 investor tax. But the monthly payment doesn't even tell the whole story. Let's look at the total interest paid over 30 years. On the home loan, you'll pay the bank about $382,000 in interest for the privilege of borrowing that money. On the investment loan, you will pay them over $436,000. That is a difference of more than $54,000. $54,000. That's a new car. That's a college fund. That's a life-changing amount of money that you are paying for no other reason than the bank has labeled your loan as risky. It's a slow, methodical bleed that drains profit directly from your investment for the next 3 decades. And we're still not done. There's one more financial hurdle, a particularly sneaky one. Private mortgage insurance, or PMI. If you get a conventional home loan and put down less than 20%, the lender sees a gap. A risk gap. If you default early on and they have to foreclose, the sale of the house might not cover the full loan amount. To protect themselves from this, they force you to buy insurance. But here's the kicker. This insurance doesn't protect you. Protects them. You pay a monthly premium, often hundreds of dollars, for an insurance policy that pays out to the bank if you fail. It's a brilliant business model. This PMI payment gets added to your monthly mortgage bill. And it's one of the most frustrating costs of homeownership, because you get absolutely nothing for it. The good news is, once your loan balance drops to about 80% of the home's value, you can request to have it removed. It doesn't last forever. Now, what about investment loans? Well, here's a rare bit of good news, sort of. You typically don't have to worry about PMI on an investment property. Why? Because, as we already established, the bank is already forcing you to put down at least 20 or 25%. By demanding such a massive down payment, they've already eliminated the risk that PMI is designed to cover. They've essentially forced you to self-insure by putting so much of your own cash into the deal from day one. So you avoid the monthly PMI fee, but only because you had to come up with an astronomical sum of money up front. It's not a gift, it's a consequence. So the bank has made it painfully clear with your wallet that these are two different animals. The financial hurdles are just the beginning. The real trap, the one that can land you in legal hot water with massive fines or even jail time, isn't in the numbers. It's in the rule book. It's about what you promise the bank you'll do with that property versus what you actually do. And the line between a smart strategy and federal fraud is thinner than you think. So let's walk across that line. Let's see exactly where a clever investment strategy turns into a felony. The official term for it is occupancy fraud. And it's one of the most common and most misunderstood types of mortgage fraud in the United States. In simple terms, it's lying to a lender about whether you're going to live in the house you're buying. You check the box on the loan application that says primary residence, but you have absolutely no intention of ever moving in. Your real plan from the very beginning is to rent it out as a full-time investment property. Now, why would anyone do this? The motivation is powerful. It's the same reason people speed on the highway. They want to get to their destination faster, and they think they won't get caught. The destination here is financial freedom, and the vehicle is a primary residence loan. As we've discussed, these loans are the VIP pass of the mortgage world. You get the lowest down payment requirements, think 3.5% for an FHA loan or even 0% for a VA loan, compared to the 20 or 25% you'd need for an investment property. You get the lowest possible interest rates, which means a lower monthly payment and more cash flow. The underwriting is less strict, making it easier to qualify in the first place.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The temptation is immense. You run the numbers both ways, as an investment property versus a primary home, and the difference isn't just a few dollars. It's the difference between a mediocre deal and a home run. It's the difference between being able to afford the property or having it remain just out of reach. So let's create a character. We'll call him Alex. Alex is 28, he's smart, he's been saving his money, and he's been binge-watching real estate content online. He's ready to buy his first property. He finds a great duplex in a growing neighborhood. It's perfect. He could live in one unit and rent out the other, a classic and completely legal strategy called house hacking. But Alex gets greedy. He thinks he's found a better way. He still lives in a cheap apartment with a roommate that he loves. He doesn't actually want to move. He just wants the duplex as a pure cash-flowing machine. He does the math. With a 25% down payment for an investment loan, the cash flow is okay but not great. His savings would be almost completely wiped out. But then he runs the numbers using an FHA loan with a 3.5% down payment. The difference is staggering. The monthly payment is hundreds of dollars lower, and he gets to keep a huge chunk of his savings in the bank as a safety net. The cash flow is incredible. Feels like a cheat code. An online guru in a flashy video told him, "The banks don't actually check. Just say you're going to live there, keep your mouth shut for a year and you'll be fine." Everyone does it. So Alex does it. He fills out the uniform residential loan application. He gets to the section about the property's purpose. He sees the options: primary residence, secondary residence, investment property. His finger hovers. He knows his plan. He knows he has a lease on his apartment for another 10 months. He knows he has no intention of moving. But the allure of that extra cash flow, of beating the system, is too strong. He checks the box for primary residence. He signs the bottom of the form, right under a statement printed in bold capital letters, a statement he barely glances at, warning him that he is certifying under penalty of perjury that all the information is true and correct, and that lying on the application is a federal crime. The loan sails through underwriting. The bank is happy because they believe they're making a low-risk loan to a homeowner. Alex is ecstatic. The deal closes. He gets the keys, does a little cosmetic work, and immediately finds tenants for both units. The rent checks start rolling in. He's making a killing. He feels like a genius. He's a real estate investor. He played the game and won. For 6 months, everything is perfect. And this is the dangerous part. This is why people do it. Because for a little while it works. The crime pays off. Until it doesn't. The problem with a lie like this is that it doesn't just exist in a single moment. It's not a single checkbox on a form. It's a thread that you have to keep weaving, and eventually, those threads create a tapestry that can unravel at the slightest pull. And there are so many ways for that pull to happen. First, there's the mail. Alex has his mortgage statement, his insurance bill, and his property tax bill forwarded from the duplex to his real apartment. This seems like a simple, logical thing to do. But lenders have systems for this. They use mail forwarding tracking services. If a borrower, within the first year of an owner-occupied loan, immediately forwards all their mail to a different address, it raises a massive red flag in the system. An auditor might be assigned to take a closer look. Then there are the utilities. Let's say the lender does a random quality control audit on Alex's loan. This is a standard practice. They might ask him to provide copies of utility bills for the duplex to verify his residency. What's he going to do? The electricity and water bills have been in his tenant's name since day one. He can't produce a bill with his name on it. The lie starts to crack. Let's talk about insurance. Alex, being a savvy but not savvy enough investor, got a landlord policy for the property, not a homeowner's policy. This makes sense for a rental. But the insurance company sends the policy details to the mortgage lender, as the lender is listed as a loss payee. An underwriter or a loan servicer sees a DP3 landlord policy on a loan that was originated as an owner-occupied HO3 property. Another red flag goes up. The system is designed to catch these discrepancies. And it gets more mundane than that. A year later, the city's tax appraiser comes by to reassess the property's value. He knocks on the door and Alex's tenant answers. The appraiser asks, "Does Alex live here?" The tenant, having no idea what's going on, says, "Oh no, he's our landlord. He lives across town." That little piece of information gets noted and can easily find its way back to the lender through public records or data sharing agreements. But the most common way people get caught is on their next deal. A year and a half goes by and Alex, flush with cash and confidence, decides to buy another property. This time he actually wants to buy a house for himself to live in. He goes to a different lender to get pre-approved. The new loan officer pulls his credit report. He sees the FHA mortgage for the duplex. He asks the standard question. "So your current residence is the property at 123 Main Street?" Alex says yes because he has to maintain the original lie. The loan officer continues. "Okay, so you plan to sell that property or turn it into a rental once you move into the new house?" And here is the trap. If Alex says, "I'm going to keep it as a rental," the underwriter at the new bank will dig deeper. They'll ask for the lease agreements and rental history for the duplex. And when they see the leases are dated from the week he bought the property 18 months ago, the whole scheme collapses. They will deny his new loan and in most cases, are obligated to report the suspected fraud on his original FHA loan. This is when the friendly calls from the bank stop, and the certified letters from the legal department begin. And the consequences are not a slap on the wrist. The first and most likely outcome is that the lender will call the note due. This is a clause in every mortgage contract. It means the bank demands the entire remaining balance of the loan, let's say $300,000, be paid back immediately, in full. Alex doesn't have $300,000. Almost nobody does. This forces him to either sell the property in a fire sale or more likely, go into foreclosure. His credit is destroyed for a decade, and he loses the property and all the equity he thought he had. But it can get much, much worse. Because he checked that box on a federal form for a federally insured loan, he didn't just break a rule with the bank. He committed a federal crime. We're talking about violations of 18 U.S. Code Section 1344 bank fraud. This carries a penalty of up to 30 years in prison and a $1 million fine. Because he used the U.S. mail or any private carrier to send or receive documents related to this fraudulent loan, he could also be charged with mail fraud. This isn't a theoretical risk. The FBI has entire departments dedicated to investigating this. Now you might be thinking, but what if my plans genuinely change? And that is the critical distinction. Intent. The law cares about your intent at the moment of closing. If you buy a home with the full and honest intention of living in it, and 6 months later you get an incredible unexpected job offer in another state, or a family member gets sick and you have to move to care for them, that is not fraud. Life happens. The key is to be honest and to document everything. You call your lender, explain the situation, and formally request permission to convert the property to a rental. In most legitimate cases, they will grant it. You're being transparent. You're not trying to deceive anyone. What Alex did was deception from the very beginning. His plan from day one was to violate the sworn statement he made on his loan application. He didn't have a change of plans. He had a fraudulent plan from the start. That's the difference between an unfortunate life event and a federal indictment. So the feds knocking on your door is the absolute worst-case scenario. But let's be clear. The consequences of mixing up these loans don't stop there. Even if you have the best intentions, choosing the wrong loan path can cost you a fortune and slam the door on your financial goals. It all comes down to one single powerful word: risk. Everything, and I mean everything, that makes these two loans different boils down to how the lender views risk. And their perspective is brutally simple. To a bank, your primary residence, the place you come home to, the place where your kids sleep, the place where you have Thanksgiving dinner, is a fortress. It's an emotional asset. History shows that people will do almost anything to avoid losing their home. They'll sell their car, eat ramen noodles for a year, take on 3 jobs. They will defend that fortress to the very end. An investment property? To a bank, that's not a fortress. It's a factory. It's a business unit on a spreadsheet. Its only job is to produce income. And if that factory starts losing money, if the numbers on that spreadsheet turn red, a logical business person might make a logical business decision: shut it down. They might walk away. It's not personal, it's just business. This fundamental difference in perceived risk is the Grand Canyon that separates these two types of financing. And it shows up in 3 major ways: the interest rate, the down payment, and the sheer torture of the approval process. Let's start with the most obvious one: the interest rate. Lenders charge more for risk. It's that simple. Because they believe there's a higher chance you'll default on an investment property loan, They charge you a premium for taking on that risk. This is called a risk-based pricing adjustment. Typically, you can expect the interest rate on an investment property to be anywhere from 0.5% to a full percentage point higher than it would be for an identical loan on a primary residence. Now, 0.5% might not sound like much. You might think, big deal. But let's run the numbers. Let's say you're getting a $300,000 loan. For your primary home, you lock in a rate of 6.5%. Your monthly principal and interest payment is about $1,900. But for that same $300,000 house as an investment property, the bank quotes you 7.25%. That's a pretty standard difference. Your new monthly payment is now over $2,050. That's an extra $150 a month. Over a year, that's $1,800. And over the full 30-year life of the loan, you will have paid over $55,000 in extra interest. 55 grand for the exact same house. All because the bank sees it as a riskier bet. That's the toll booth you have to pay to enter the world of real estate investing. Next up is the barrier to entry, the down payment. For a primary residence, especially if you're a first-time homebuyer, the options are incredible. You've got FHA loans that let you get in the door for as little as 3.5% down. You have conventional loans that can go as low as 3% or 5% down. The system is designed to help you get into a home. For an investment property, forget about it. The bank wants you to have serious skin in the game. They see a low down payment as a massive red flag. If you've only put a tiny amount of your own money into the deal, you have very little to lose by walking away if things go south. So they slam the door on low down payment options. For a standard, conventional investment property loan, you should expect to put down a minimum of 20%. And frankly, in today's tighter lending environment, many banks won't even talk to you unless you're bringing 25% to the table. Think about that. On that same $300,000 house, a primary homebuyer might need to scrape together $9,000 for a 3% down payment. The investor needs to show up with a check for $75,000. That's a completely different universe. This down payment requirement is the great filter. It's the first, and often the last, hurdle that separates aspiring investors from actual investors. But let's say you've got the down payment. You've accepted the higher interest rate. You're ready to go. Now you enter the real gauntlet, the true test. It happens in a quiet, beige-colored office by a person called an underwriter. And for an investor, the underwriting process is a financial colonoscopy. For a primary home loan, the underwriter is basically asking one question. Can this person afford this house payment based on their current job? They look at your pay stubs, your tax returns, and your existing debts like car loans and credit cards. They calculate your debt-to-income ratio, or DTI. It's a relatively straightforward calculation. For an investment property loan, the underwriter is asking a much more complicated question. Are we funding a viable business? And is this person a capable CEO of that business? They don't just underwrite you. They underwrite the deal itself. This is where so many new investors get a brutal wake-up call. Let's say the property you want to buy could rent for $2,000 a month, and the total mortgage payment with taxes and insurance is $1,600. You think, great, this thing cash flows $400 a month from day one. The bank will love this. Wrong. The bank doesn't see $2,000 in rent. The bank sees risk. They see potential vacancies, repairs, and management costs. So, they'll typically only count about 75% of the gross rental income when qualifying you. So, in their eyes, your $2,000 a month rental is only bringing in $1,500. But your payment is $1,600. Suddenly, your cash-flowing property looks like a money-losing disaster to the underwriter. They see a negative cash flow of $100 a month, and that deficit gets added to your debt-to-income ratio, making it even harder to qualify. And then comes the final question, the one that separates the serious from the wishful thinkers. After they've scrutinized your income, your credit, and the deal itself, the underwriter will say, "Show me the reserves." Cash reserves. They want to see that you have enough liquid cash in your bank account to cover the property's expenses for a period of time if the tenant leaves. They want to know you can weather a storm. How long? Typically, they want to see 6 months of pity, that's principal, interest, taxes, and insurance, in a savings or checking account. So for that property with a $1,600 monthly payment, they want to see that you have an extra $9,600 just sitting there untouched, after you've paid your massive $75,000 down payment and all your closing costs. This is the knockout punch for so many people. It's one thing to save up for a down payment, It's another thing entirely to have that much extra cash just parked on the sidelines. It's the bank's ultimate insurance policy, and it's non-negotiable. So you see the difference? A primary home loan is a path. An investment loan is an obstacle course. One is designed to get you in. The other is designed to keep you out unless you can prove, beyond a shadow of a doubt, that you are a rock-solid financial bet. The system isn't trying to be mean. It's just trying to protect its money. But the result is a dramatically different experience for the borrower. It's tougher, it's more expensive, and it requires a level of financial strength that a typical homebuyer simply doesn't need. It sounds like a raw deal, right? It sounds like the system is rigged against the little guy trying to get ahead. But what if I told you that in some ways the investment loan has a hidden superpower? A secret advantage that a primary home loan could never offer. That superpower is the United States tax code. Now stay with me. I know talking about taxes can feel like watching paint dry. But this is the secret key that unlocks the entire world of real estate investing. This is the reason why the rich get richer using property. It's not just about rental income. It's about transforming an asset into a full-fledged, tax-advantaged business. Your primary home is, well, it's a home. The government gives you a couple of nice but limited tax breaks for owning it. You can generally deduct your mortgage interest up to a certain limit currently. That's on a total mortgage debt of $750,000. You can also deduct your property taxes, but again, there's a cap. The state and local tax or SALT deduction is capped at $10,000 per household. That's it. That's the whole list. If your roof springs a leak, you can't deduct the repair. If you have to replace the water heater, that's on you. Your homeowner's insurance? Not a deductible expense. But the moment that property is classified as an investment, everything changes. The rulebook is thrown out the window and you get to play an entirely different game. That property is no longer just a building. It's a business. And businesses have expenses. And in the eyes of the IRS, nearly every single dollar you spend to operate that business can be used to reduce your taxable income. Let's run through this because the list is staggering. First, mortgage interest. Remember how your primary home has that $750,000 limit? For an investment property, that limit disappears. 100% of the interest you pay on that investment loan is a deductible business expense. Whether the loan is for $300,000 or $3 million, every penny of interest works to lower your tax bill. Property taxes, fully deductible as a business expense, with no $10,000 SALT cap applied to the business. That homeowner's insurance you couldn't deduct on your primary residence? It's now called landlord insurance, and guess what? It's 100% deductible. Now for the big one, repairs and maintenance. Every single thing you do to keep that property in good rentable condition is a write-off. The plumber you call to fix a clogged drain? Deductible. The electrician to fix a faulty outlet? Deductible. The painter you hire to freshen up the walls between tenants? Deductible. Landscaping, pest control, even the cost of changing the locks, it's all part of the cost of doing business, and it all reduces your taxable income. And the list just keeps going. Do you pay an HOA fee? That's a business expense. Deductible. Do you hire a property manager to handle the day-to-day headaches? Their entire fee is deductible. Did you have to pay a lawyer to draft a lease agreement? Or an accountant to help with your taxes? Their fees are deductible. Did you run an ad on Zillow or Facebook Marketplace to find a new tenant? The cost of that ad, you guessed it, is deductible. Gets even better. Let's say your rental property is a 2-hour drive away. If you drive there to show the property, to meet a contractor, or to do an inspection, you can deduct your mileage. The IRS sets a standard mileage rate every year. And those trips can add up to a significant deduction you would never get for just driving to and from your own home. But all of those powerful deductions are just the opening act. They are nothing compared to the single greatest tax benefit in the entire real estate investing universe. A concept so powerful it feels like a cheat code for the financial system. It's called depreciation. Depreciation is the magic trick that allows real estate investors to earn positive cash flow, real money in their bank account, while legally telling the IRS they lost money. Here's how it works. The IRS understands that buildings, just like equipment, wear out over time. So they allow you, the owner of the business, to deduct a portion of the property's value each year to account for this theoretical wear and tear. For a residential investment property in the US, the IRS says you can depreciate the value of the building. Not the land, just the building, over a period of 27.5 years. This is a phantom expense. I want you to burn that phrase into your brain. It's a phantom expense because you don't actually spend any money. It's a deduction you get on paper, without a single dollar ever leaving your pocket. Let's use a simple concrete example. You buy an investment property for $400,000. The land it sits on is valued at $100,000, and the building itself is valued at $300,000. The IRS lets you take that $300,000 building value and divide it by 27.5. $300,000 divided by 27.5 years equals $10,909. That means every single year for the next 2.5 decades, you get to deduct over $10,000 from your rental income as a depreciation expense. You didn't write a check for it. You didn't swipe a credit card. It's a massive automatic deduction gifted to you by the tax code. Now let's put this all together and see the superpower in action. Imagine that same $400,000 property. Let's say you rent it out for $3,000 a month. That's $36,000 a year in gross rental income. Now let's subtract your real cash expenses. Your mortgage payment might be $2,200 a month, but a big chunk of that is principal. Let's say the interest part is $1,500 a month, or $18,000 a year. Property taxes are $4,000 a year. Insurance is $1,500 a year. And let's budget $2,500 for repairs and maintenance. So your total cash expenses are $18,000 for interest, plus $4,000 for taxes, plus $1,500 for insurance, plus $2,500 for repairs. That's a total of $26,000 in cash expenses. Your income was $36,000. Your cash expenses were $26,000. That means you have $10,000 of positive cash flow. That's 10 grand in your pocket. A successful investment, right? But normally, you'd have to pay income tax on that $10,000 profit. But wait, we forgot our phantom expense. We forgot about depreciation. We take that $10,000 of profit and we subtract our depreciation deduction of $10,909. $10,000 minus $10,909 equals negative $909. Let that sink in. You put $10,000 of real cash into your bank account. But on your tax return, you get to report to the IRS that you actually lost $909 on the property. You made money, but you declare a loss. This means you pay zero, absolutely zero income tax on that $10,000 you earned. This is the superpower. This is the game. An investment loan with its slightly higher rates and down payments unlocks the door to this world. A primary home loan keeps that door firmly shut. You can't depreciate the home you live in. You can't deduct the cost of fixing your own garbage disposal. The government views your home as a personal expense, but it views your rental property as a miniature economic engine, and it provides a mountain of incentives through the tax code to encourage you to run it. The higher interest rate on an investment loan is a small price to pay when the interest itself is a tax write-off. The larger down payment is a barrier to entry, but it's the ticket you buy to access a system that can legally eliminate the tax on your profits. So the investment loan, which looked like the worst deal on the surface, more expensive, harder to get, suddenly looks like the smarter financial instrument for wealth creation. It's the key to turning your income into tax-advantaged, or even tax-free cash flow. But this incredible power comes with a dark side, a hidden danger. For every action, there is an equal and opposite reaction, and the world of investment loans is no different. We've just talked about the immense upside, the superpower that can make you rich. But what about the kryptonite? What are the massive portfolio-destroying risks that come attached to an investment loan that simply don't exist when you're just buying a place to live? The answer to that is more terrifying and more important than you might think. It boils down to one single terrifying word: recourse. That's it. That's the kryptonite. For a primary home loan, especially in certain states like California, Arizona, or Oregon, many mortgages are what's known as non-recourse. This is a term that sounds boring, but it is your single greatest financial shield. Non-recourse means that if the absolute worst happens, you lose your job, the market crashes, you can't make payments, the bank can take the house. That's the deal. They can foreclose, sell the property, and whatever they get is what they get. They cannot come after you personally for the rest. Your 401k, your savings account, your future wages, they are shielded. The collateral for the loan is the house, and only the house. But with an investment loan, that shield is gone. Almost all conventional investment property loans are full recourse loans. This changes the entire game. A recourse loan means the bank isn't just lending against the property, They are lending against you. Your entire financial existence is the collateral. So let's replay that worst-case scenario. The market tanks. Your rental property is now worth $100,000 less than you owe. Your tenant loses their job and stops paying rent. You can't cover the mortgage anymore. The bank forecloses. But they can't sell the house for what you owe them. Let's say you owe $300,000, but they can only sell it for $200,000 at auction. With a non-recourse home loan, that's the end of the story. The bank takes a $100,000 loss. With your full recourse investment loan, this is just the beginning of your nightmare. The bank now comes after you personally for that $100,000 difference. It's called a deficiency judgment. They can garnish your wages, taking money directly from your paycheck before you ever see it. They can levy your bank accounts, draining your life savings overnight. They can put liens on your other assets, your car, your primary home, any other investments you have. They will pursue you with the full force of the legal system until they are made whole. You don't just lose the investment property. You risk losing everything. The investment loan is not a contained risk. It's a virus that's designed to infect your entire financial life if things go wrong. And you have to ask why? Why are banks so much more ruthless with investors? Simple psychology. They know that you will fight to the death to keep the roof over your family's head. A primary home is an emotional anchor. You'll sell your car, get a second job, eat ramen noodles for a year before you let the bank take your home. An investment property, on the other hand, is just a number on a spreadsheet. If it becomes a bad number, a logical, unemotional investor is far more likely to do a strategic default, to simply mail the keys back to the bank and walk away from a bad deal. The banks know this, so they use recourse to make it personal. They chain the property to your personal finances so you can't just walk away. You are on the hook, personally and completely. This fundamental difference in risk, personal liability, creates a domino effect that magnifies every other risk associated with real estate. Take vacancy. When you buy a home to live in, there is no vacancy risk. You are the tenant. You're paying the mortgage whether you have a job or not because you need a place to live. But with an investment property, every single day it sits empty, you are hemorrhaging cash. You are paying the principal, the interest, the taxes, and the insurance, the full pity, out of your own pocket with zero income to offset it. Let's say your mortgage on a rental is $2,000 a month. It takes you 2 months to find a good tenant. That's $4,000 out of your savings before you've made a single dime. Then that tenant stays for a year and leaves. You have to paint, replace the carpet, and fix the dishwasher. That's another $3,000 in turnover costs, plus another month of vacancy while you do the work. That's another $2,000. In just over a year, you've bled $9,000 from your personal accounts. And if you face a real problem like a professional tenant who knows how to work the eviction system, you could go 6 months without rent while paying legal fees. That could be a $15,000 or $20,000 hole. If you don't have that cash sitting around, you start missing mortgage payments. And because it's a recourse loan, the bank's legal team doesn't just start foreclosure on the property. They start preparing the lawsuit against you. This is compounded by the interest rate risk. Investment loans are always, without exception, more expensive. A bank might offer a homeowner a 6% interest rate, but that same day, for the exact same property, they'll offer an investor a 7% or 7.5% rate. It doesn't sound like much, but on a $300,000 loan, a 1.5% difference is over $350 a month. That's over $4,000 a year. That $4,000 is your margin of safety. It's the money that should be going into your capital expenditures fund for a new roof or a water heater. But instead it's going directly to the bank every single month just for the privilege of taking on more risk. The higher rate eats your cash flow, leaving you with a razor-thin buffer for when, not if things go wrong. The very tool the bank uses to price in your higher risk, the interest rate, is what actively makes you riskier by starving your investment of the cash flow it needs to survive. And finally, there's the liquidity risk born from the down payment. To get a primary home loan, especially with programs like FHA, you can put down as little as 3.5%. On a $300,000 home, that's just over $10,000. You can keep the rest of your savings liquid and available for emergencies. For an investment property, forget it. The bank will demand a minimum of 20%, and more likely 25%. On that same $300,000 property, you now have to come to the table with $75,000 in cash. For many first-time investors, that's their entire life savings. They are pouring every liquid dollar they have into a single illiquid asset. Think about the chain reaction.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
You drain your savings for the 25% down payment. You're hit with a higher interest rate that eats your cash flow. Then you get a few months of vacancy and a major repair bill on top of that. You have no cash reserves because you dumped it all into the down payment. You have no cash flow because the bank is taking it all in interest. You are trapped. You can't easily sell the property because it takes months, and you have to pay realtor commissions. You can't make the mortgage payment. And the clock starts ticking on a foreclosure and a deficiency judgment that could follow you for the rest of your life. This is the brutal reality. A home loan is a tool for shelter, with built-in protections. An investment loan is a tool for leverage, with built-in dangers designed to protect the lender, not you. The risks aren't just bigger. They are fundamentally different. They are personal, they are cascading, and they have the power to cause a total financial wipeout that a simple home loan never could. So if the game is this rigged, if the risks are this catastrophic, why would any sane person sign up for it? How do the pros build $100 million portfolios using these very same instruments while so many amateurs get destroyed? It's because they understand a different set of rules and a different type of financial architecture that insulates them from these risks. They don't just get a loan, they build a fortress around it. And understanding how they do that is the key to everything. So let's pull back the curtain on this fortress. The very first, non-negotiable foundation stone is something most people never even consider. Sophisticated investors almost never buy property in their own name. Let me repeat that. They do not hold the title to their investment properties as John or Jane Smith. Instead, they create a separate legal entity, most commonly a limited liability company or LLC, and that LLC is what actually buys and owns the property. This isn't just a fancy bit of paperwork. It is the entire game. It's the equivalent of a knight putting on a suit of armor before going into battle, while the average homebuyer walks in wearing a t-shirt. Why? One word: liability. When you buy your primary residence with a home loan, you and the house are one and the same in the eyes of the law and the bank. If someone slips on your front steps and sues you, they are suing you. They can come after your salary, your savings, your car, everything. The house is just the beginning of your exposure. But when an LLC owns an investment property, a legal wall, often called the corporate veil, is erected between the property and your personal life. Imagine you own a fourplex, and a tenant's guest trips on a loose carpet and decides to sue for $1 million. If you own that property in your personal name, that lawsuit is a direct threat to your entire net worth. But if 123 Main Street LLC owns the property, they sue the LLC. Their claim is limited to the assets held within that LLC, which is typically just the equity in that specific property. The lawsuit stops at the LLC's door. It cannot pass through that corporate veil to touch your personal home, your retirement accounts, or your kid's college fund. It is a financial firewall. This is the single most important structural difference, and it fundamentally changes the nature of the risk you are taking on. You're no longer betting your entire financial life on a single investment. You're isolating the risk to the investment itself. Now, a smart investor doesn't just stop at one suit of armor. They build an entire armory. Let's say their first property, that fourplex, is owned by 123 Main Street LLC. It does well, so they buy another property, a small apartment building across town. Do they put it in the same LLC? Absolutely not. Because if they did, a lawsuit at one property could now threaten the equity of the other. They've just doubled the assets at risk inside that single entity. Instead, they create a brand new separate entity, 456 Oak Avenue LLC. Each property is quarantined in its own legal and financial silo. A fire, a lawsuit, a major financial problem at one property cannot infect the others. This is called asset compartmentalization. But then they take it one step further. They create what's called a holding company. This is often an anonymous LLC or a trust set up in a state with strong privacy laws like Wyoming or Delaware. Let's call it Apex Holdings LLC. This holding company doesn't own any property directly. Instead, it owns the other LLCs. So, Apex Holdings LLC owns 123 Main Street LLC and 456 Oak Avenue LLC. You, the investor, simply own the holding company. This structure does two incredible things. First, it adds another thick layer to the fortress, making it even harder for anyone to get to your personal assets. Second, it creates anonymity. If someone tries to look up who owns 123 Main Street, they won't find your name. They'll find another LLC, which is in turn owned by another LLC, creating a trail that is incredibly difficult and expensive for a frivolous lawsuit to follow. This is the architecture. This is the fortress. It's a series of walls and moats designed to protect the king and queen in the castle, you and your personal wealth. So where does the investment loan fit into this sophisticated structure? This is where people get confused. They think, if the LLC is buying the property, does that mean I'm off the hook for the loan? The answer, especially when you're starting out, is no. When you, through your newly formed LLC, go to a commercial lender for an investment loan, they know the LLC has no history, no income, and no credit. It's a brand new entity. They are not just going to hand over hundreds of thousands of dollars to a shell company. So they will require you, the owner of the LLC, to sign what is called a personal guarantee. This is a critical document. The personal guarantee, or PG, is a legal agreement that says if the LLC fails to pay the mortgage, the bank can pierce through that corporate veil and come after you personally to collect their debt. It's the bank's key to a backdoor in your fortress. At first, this sounds like it defeats the whole purpose of the LLC. But it doesn't. You have to understand what is being protected from what. The LLC and the corporate veil are still protecting you from all operational liabilities. The slip and fall lawsuits, the vendor disputes, the tenant issues. The personal guarantee only exposes you to one specific, calculated risk: the loan itself. You are telling the bank, I stand behind this debt. But you are not telling the whole world. My entire net worth is on the table for any problem that ever happens at this property. You've traded a universe of infinite unknown risks for one single known risk: the mortgage payment. This is a massive upgrade in risk management compared to a standard home loan, where every type of risk leads directly back to you. But this is where the path for the professional investor truly diverges. The personal guarantee is not the end of the road. It's the beginning. As that investor successfully buys, manages, and pays the mortgage on a few properties, they are building something more valuable than equity: a track record. They are proving to the bank that they are a reliable, competent, and profitable operator. After a few years and a few successful deals, they can go back to the bank for their next loan and begin a new negotiation. They can say, look at my portfolio. Look at my history of performance. I want a non-recourse loan. A non-recourse loan is the holy grail of real estate financing. It is a loan without a personal guarantee. With a non-recourse loan, the bank agrees that if the loan goes into default, their only remedy, their only recourse, is to take back the property itself. They cannot come after the LLC's other assets, and more importantly, they absolutely cannot come after you personally. The back door to the fortress is now sealed. At this stage, the investor has truly insulated themselves. The risk has been almost entirely shifted to the lender. The deal must stand on its own 2 feet. If the investment fails, the investor loses the property and any cash they put into it, but their personal financial life remains untouched. This is how massive multi-billion-dollar real estate empires are built. Not by signing a personal guarantee on every building, but by building a system and a track record that makes the bank comfortable betting on the deal itself, not on the person behind it. This structure, this evolution from personal liability to entity liability, and from recourse to non-recourse debt, is not just a different way to get a loan. It's a completely different financial philosophy. It's about controlling risk, building scalable systems, and protecting your core wealth so you can continue to play the game. This isn't just about protecting what you have. It's about fundamentally changing the way you build wealth. It's the difference between being a passenger in your financial life and being the architect. And the tax implications of this architecture, well, that's where the game is truly won. Let's talk about the US tax code. For most people, those 4 words are enough to make their eyes glaze over. They think of it as a complex, punishing system designed to take their hard-earned money. And for most people, they're right. But for the architect, for the investor, the tax code isn't a punishment. It's a rulebook. It's a set of incentives, a blueprint left by the government that literally tells you how to build wealth and pay less tax. And the single biggest chapter in that blueprint is written around real estate. When you get a home loan for your primary residence, the government gives you a thank you gift. The most famous one is the mortgage interest deduction. You can deduct the interest you pay on up to $750,000 of mortgage debt from your taxable income. Let's be clear. This doesn't reduce your tax bill dollar for dollar. It reduces the amount of your income that gets taxed. If you're in a 24% tax bracket and you deduct $10,000 in interest, you save $2,400. It's a nice perk, a helpful discount on the cost of homeownership. You can also deduct your property taxes, but that's capped along with your state and local income taxes at a total of $10,000 per year thanks to the SALT cap. For many people in higher tax states, that benefit gets eaten up very quickly. The real superstar tax benefit for a homeowner comes when you sell. It's the capital gains exclusion. If you've lived in your home as your primary residence for at least 2 of the last 5 years, you can sell it and pay absolutely zero tax on your profits, up to $250,000 if you're single, or a whopping $500,000 if you're married. Think about that. You could buy a house for $400,000, live in it, watch it appreciate to $900,000, and then walk away with $500,000 of pure tax-free profit. It is one of the most generous provisions in the entire tax code. It's a golden parachute, a reward for participating in the American dream. But here's the key. It's an exit strategy. It's a one-time cash out. You take your winnings off the table, and the game is over for that property. Now let's open the other playbook. The one for the investment loan. This isn't a thank you gift. This is a business partnership with the IRS. When you buy an investment property, you are no longer just a homeowner. You are a business owner. And every single expense related to running that business becomes a potential tax deduction against the income it generates. The mortgage interest? Deductible. And there's no $750,000 cap on the loan amount for this purpose. The property taxes? Deductible, and they are not subject to that $10,000 SALT cap. The insurance premium? Deductible. The cost of a new roof, a leaky faucet, the plumber you called at 2 a.m.? Deductible. The fee you pay a property manager? Deductible. The cost of advertising for a new tenant? Deductible. Even the miles you drive to check on your property can be deducted. You are running a business and the tax code rewards business owners. But all of that is just the opening act. The main event, the secret weapon of the real estate investor, is a concept called depreciation. This is where your mindset has to shift from employee to owner. The government assumes that a physical building wears out over time, so they allow you to deduct a portion of the building's value from your rental income each and every year as a phantom expense. For a residential property in the US, you get to depreciate it over 27.5 years. Let's make that real. You buy a rental property for $350,000. The land itself isn't depreciable, so let's say the land is worth $75,000 and the building is worth $275,000. You divide that building value by 27.5 years. That gives you $10,000. This means you get to tell the IRS that you had a $10,000 business expense this year, even though you didn't actually spend a single dollar. It's an expense that exists only on paper, for tax purposes. Now, imagine your property brings in $25,000 a year in rent. Your actual cash expenses, interest, taxes, insurance, repairs, come to $20,000. So you have $5,000 of positive cash flow, money in your pocket. But for tax purposes, you get to subtract that extra $10,000 depreciation expense. Suddenly, on paper, your $5,000 gain becomes a $5,000 loss. You made money, but you get to report a loss to the IRS, meaning you pay zero income tax on that cash flow. In fact, under certain rules, you might even be able to use that paper loss to offset income from your day job. This isn't a loophole. It is the law. It is the government actively incentivizing you to provide housing. So what's the catch? When you sell the investment property, the government wants its due. You'll have to pay capital gains tax on your appreciation. And all that depreciation you claimed over the years, you have to pay that back in something called depreciation recapture tax, which is capped at 25%. This is the point where the amateur sells, pays a massive tax bill, and complains about the system. But the architect, the professional investor, knows the final rule in the playbook. It's called a 1031 exchange. This is the ultimate wealth-building tool in real estate. The 1031 exchange allows you to sell your investment property, and as long as you roll all the proceeds into a new, like-kind investment property within a specific time frame, you defer paying any capital gains or depreciation recapture tax. You kick the can down the road. You sell that $350,000 property for $600,000. Instead of paying taxes on your $250,000 gain, you take the entire $600,000 and buy $1 million apartment building. You just traded up, increased your cash flow, increased your depreciation benefits, and paid zero tax. You can do this again and again and again. You can trade one house for two for a small apartment building, that building for a larger one, and so on. You are deferring your tax burden into the future, while your assets and cash flow grow exponentially in the present. This is how fortunes are built. It's called swap till you drop, because if you hold these properties until you pass away, your heirs inherit them at a stepped-up basis, meaning the market value at the time of your death becomes their new cost basis. That deferred tax liability can be wiped out forever. So let's put it all on the table. A home loan is for your castle. It gives you stability, pride of ownership, and a fantastic tax-free profit when you sell. It's a strategy for building a nest egg. An investment loan is for your empire. It turns a property into a tax-advantaged business. It allows you to deduct expenses, generate paper losses to shelter real cash flow through depreciation, and use the 1031 exchange to defer taxes indefinitely, building generational wealth. It's a strategy for building a dynasty. One is about consumption. The other is about production. One is about saving money on taxes. The other is about using the tax code to make money. The incredible thing is, you don't have to choose. The savviest people understand how to use both. They start with a strategy like house hacking, buying a duplex with a homeowner loan, living in one side and renting out the other. They get the benefits of homeownership while having their tenant pay their mortgage. They get their feet wet as a landlord. After a year, they move out, convert the whole property to a full rental, and do it again. They use the rules of the homeowner game to acquire assets for the investor game. The difference between a home loan and an investment loan isn't just in the interest rates or the down payments. It's a difference in philosophy. It's the difference between playing checkers and playing chess. Both are great games, but only one allows you to think 10 moves ahead. Understanding this distinction is the key that unlocks the door between financial security and true financial freedom. The question you have to ask yourself isn't just where you want to live. The real question is, what do you want your money to build? A home or an empire? If this breakdown finally made the complex world of real estate taxes make sense, do me a favor and smash that like button. It tells the algorithm that this is the kind of valuable information people need to see. And I want to know your thoughts. Drop a comment below. Are you on Team Home Loan, Team Investment Loan? Or are you ready to start playing in both leagues? And of course, if you want more of the financial secrets that the wealthy use to get ahead, make sure you subscribe and turn on notifications so you don't miss what's coming next.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.